Welcome to The Explainer. Today, we're deconstructing the engineered liquidation of America's retail empires. And we're doing it with absolute objectivity. Because here's the thing, your favorite legacy retail giant isn't just dying a natural death, it's being systematically cannibalized. While everyone else buys into this comfortable public narrative of shifting consumer habits, there's actually a predatory architecture of debt quietly hollowing out the balance sheets of these legacy empires. So we're going to perform a structural autopsy on the retail sector today. We're going to see exactly how institutional greed completely overrides long-term solvency. Let's get right into it. I want you to really consider this chilling reality for a second. State Representative Dan Frankel hit the nail on the head when discussing similar private equity maneuvers in healthcare. He said they were ransacked, robbed, and plundered for profit. It is the exact same playbook here. The very institutions entrusted to save these companies are actively dismantling them from the inside out. I mean, think about it. What actually happens when the people paid to manage a company are the ones pulling the plug? Well, we're about to dissect the calculated tactics where boards literally weaponize payouts to drain corporate lifeblood, leaving the employees and the creditors with absolutely nothing. Here is our intrinsic blueprint of financial decay for today. First, the illusion of retail death. Second, the architecture of masked decay. Third, we'll do an autopsy of legacy empires. Fourth, we'll uncover the motive, the executive incentive. And finally, number 5, the shield against engineered failure. All right, part 1. Let's shatter this illusion of retail death. You know, the public was fed a really convenient story. We were told it was Amazon's dominance, runaway inflation, shifting consumer preferences. Basically, we were told legacy retail simply failed to adapt. But looking at the private reality, it was a calculated starvation of capital. These companies were systematically dismantled by debt-funded capital returns and internal asset stripping. That failure to adapt, it wasn't some unfortunate accident. It was a mathematical inevitability. It was the direct result of capital being siphoned away from modernization and funneled straight into the pockets of shareholders and executives. Moving on to part 2, the architecture of masked decay. Let's look at the actual financial weaponry used here. The structural core of this entire extraction strategy involves something called a sale-leaseback. This is where a company separates its retail operations from its physical real estate. Basically, the retailer sells its buildings to an entity, like a real estate investment trust, for a massive immediate injection of cash. And then, they immediately lease those exact same buildings right back. Sure, on paper, the balance sheet looks momentarily spectacular. But in reality, it's like selling your own house just to pay for a lavish vacation. The company replaces an appreciating, non-amortizing asset with a permanent senior operating liability. They're locking themselves into rigid, inescapable rent obligations. Treat this excerpt from the New York Law Journal as irrefutable evidence of how binding this is. Notice how sale-leasebacks intentionally strip away a company's operational flexibility. These master leases frequently include what are called continuous operation covenants. This entirely removes the retailer's discretion to just close up shop or go dark, meaning they are forced to operate dying, unprofitable stores at a severe loss simply to satisfy the covenants designed to protect the buyer's investment. It's a complete trap. And that trap leads us right into the crushing vice of the CapEx starvation cycle. Watch how this sequence plays out. Step 1, the company executes that sale-leaseback or takes on heavy debt. Step 2, rather than actually reinvesting that cash into the business, they fund massive dividends and share buybacks. Step 3, to service those new massive rent obligations, they have to slash capital expenditures, which triggers Step 4, severe operational decay. When you walk into a store and see broken lighting and totally out-of-dated systems, you are looking at the physical manifestation of a hollowed-out balance sheet. This exact sequence directly caused supply chain failures, like Bed Bath & Beyond's catastrophic 2021 holiday inventory shortage. Their logistics were so starved, they literally ran out of their top-selling items. Let's turn to part 3 and actually look at the forensic data from some of these fallen empires. Scan this data for a moment, because it reveals exactly why a company would execute these taxable spin-offs in the first place. It all comes down to accumulated federal net operating losses, or NOLs. Look at companies like Sears and JCPenney. They stockpiled massive NOLs. We're talking about weaponizing over $2 billion in tax shield just to offset the immediate capital gains taxes they'd get hit with when spinning off their prime real estate to entities like Seritage. Meanwhile, you look at a company like Macy's, sitting there with zero tax shield, and they found that kind of real estate monetization completely restricted by immediate cash tax liabilities. The Sears autopsy is fascinating because it reveals a literal textbook death spiral. Under the direction of its CEO and his hedge fund, Sears spun off its real estate to Seritage Growth Properties. They also spun off their highly valuable Land's End brand, allegedly rejecting a massive $1.6 billion external offer just to keep that asset firmly under insider control. And then, a subsequent lawsuit filed by the bankruptcy restructuring team alleged that a staggering $2 billion in assets were systematically siphoned away from creditors and straight into insider hands. The complaint literally stated that these transactions were explicitly intended to transfer value to shareholders, diverting it entirely away from the company's survival. Now let this number burn into your mind for a second. $5.2 billion. That is the sheer amount of debt accrued by Bed Bath & Beyond. And it was a debt largely driven by relentless stock buyback schemes executed continuously since 2004. Industry analysts widely point to this debt-funded share repurchase strategy as the primary reason for the company's ultimate collapse. It left them entirely unable to pay their vendors, which, of course, completely choked off their merchandise supply. You just can't sell what you don't have. The trajectory of Big Lots perfectly illustrates what we call the leverage substitution effect. In 2020, they raised $588 million in a sale-leaseback transaction. But rather than investing that money into the tech they desperately needed to compete in modern retail, what did they do? They diverted the proceeds right into share repurchases. They traded flexible, funded debt for rigid lease liabilities. And that move completely obliterated their trade credit. As their operating cash flow compressed under the crushing weight of lease obligations, suppliers started demanding cash on delivery. This starved their logistics and pushed them directly into a Chapter 7 liquidation. We absolutely have to talk about the institutional predator playbook here too. It relies heavily on leveraged buyouts, or LBOs, where an acquisition is funded almost entirely by saddling the target company with massive debt. Just look at Topps Friendly Markets. They were forced to add $839 million in debt just to fund dividend recapitalizations. They essentially took out a massive loan simply to pay their new owners a cash dividend. Or observe Forever 21. They were strapped with a $1.5 billion debt load post-LBO. It absolutely decimated the company, resulting in 355 store closures and 27,000 layoffs. Joann faced bankruptcy twice under private equity ownership. The entire focus is on rapid value extraction, leaving the target company incredibly vulnerable to insolvency. So why do it? Let's move to part 4, the motive, and specifically the executive incentive. The entire architecture of this decay is rooted in a very simple mathematical formula. Earnings per share equals net income divided by weighted average shares outstanding. Because a huge portion of an executive's long-term incentive compensation is tied to EPS and total shareholder return, those executives are heavily incentivized to deploy capital towards share buybacks rather than actually reinvesting in the operations. By artificially inflating that EPS through buybacks, which reduces the denominator of that equation, executives trigger their own lucrative performance bonuses. And they do this even when the company's actual net income is totally flat or actively declining. The company quietly rots while the architects are heavily rewarded. It's a perverse incentive structure. $6.76 million. That was the exact severance guarantee for Bed Bath & Beyond's former CEO, Mark Tritton. This right here demonstrates the severe principal-agent conflict embedded in legacy retail. Executives are able to capture massive upside from short-term share price manipulation, and they are protected by golden parachutes on their way down. Meanwhile, the suppliers, the unsecured creditors, and tens of thousands of everyday workers are the ones facing the absolute ruin of insolvency. This brings us to our final section, Part 5, Building a Shield Against Engineered Failure. If we want to stop this, first, credit agreements must be ruthlessly rebuilt. We have to categorize sale-leasebacks strictly as actual asset sales. That strips retailers of the ability to hide their structural leverage in the shadows. Covenants must mandate that the proceeds from real estate monetization be reinvested directly into core operational assets or used to retire senior debt. We have to prevent the distribution of these funds as dividends or buybacks. Furthermore, financial covenants must start capitalizing all operating leases as funded debt. We need to accurately reflect the true leverage on the balance sheet. Second, executive incentives must be forcefully realigned. Boards need to replace highly manipulatable EPS metrics with long-term free cash flow yield and return on invested capital. Performance equity vesting has got to be extended to 5 to 7 years, and it needs to be backed by relentless clawback provisions to recover estate assets if a bankruptcy occurs after the executive leaves. Severance should be structured strictly as a contingent liability that gets automatically suspended during financial distress. And finally, any major asset monetization must require a formal independent solvency opinion to ensure the transaction won't leave the retailer completely unable to pay its bills. Because at the end of the day, the terminal phase of this strategy is mathematically undeniable. When the interest expense line crosses above the operating income line, the entity exists solely to pay its creditors. Do not allow yourself to become the exit liquidity for institutional predators. You have to understand the mechanics of the dividend trap, and you have to demand irrefutable mathematical evidence of true intrinsic cash flow. So as we close out this explainer, I want to leave you with one vital question. When the engineered facade finally crumbles and the assets have all been stripped, who truly pays the price?